I welcome you all to the Quarter 3 Financial Year 2020 Earnings Conference Call of Minda Corporation. As you all know, the slowdown in economic activities continues to impact auto industry. The industry continue to face volume challenge due to slow demand and destocking of BS4 inventories. In Quarter 3 Financial Year 20, the company reported revenues of rupees 6,714 million rupees, a decline of 12.7% year-on-year basis. The various austerity measures that we implemented from Quarter 1 Financial Year 20 onwards have helped us to keep our cost structure consistent, and improved product mix resulted in increase in EBITDA margins. More detail will be given by our Lakshman on financials. Looking ahead, we believe the growth in auto sector to be back on recovery road post BS6 implementation. This transaction will provide necessary stabilization and address demand and inventory pressure. I am also pleased to announce two new appointments in the senior leadership of Minda Corporation. Neeraj Mahajan has joined us as Group President Marketing and Arvind Chandra as Chief Executive Officer of Business Vertical 1, that is Mechatronics. They bring over 2.5 decades of experience, each with leading global and domestic players in the auto industry. They will strengthen our top management team. Now we shall begin the discussion of detailed financial overview and insight on operational performance. With this, I hand over to Mr. Lakshman, our Group CFO.
Thank you, Mr. Minda, and good evening, ladies and gentlemen. Here's a warm welcome again for the Q3 2020 results of ours. We have uploaded our presentation on the website, and for those of you who are referring to the presentation, I shall refer to the page numbers when I'm talking about a particular. I directly go to page number 4, where on the left-hand side we have our summary or snapshot of our group, which is diversified product portfolio, global customers, strong manufacturing, advanced R&D. We've been in the business for more than 6 decades, and that is our strength. On the right-hand side, we have a revenue breakdown for 9 months. The good news is that this has been largely consistent over the period of many quarters. A majority of our business by geography comes from India, which is about 68%. Europe and North America constitutes about 27%, and Southeast Asia is roughly about 5%. By end market, you'll see that passenger vehicles, which is about 28%, remains unchanged. Two-wheelers and three-wheelers together contribute about 41%. Commercial vehicles are at 20%, and aftermarket roughly around 11%. All of these numbers remain unchanged as compared to what we shared in our previous quarter. By business verticals, the pie chart between mechatronics at 48, information and connected systems at 32, and interior plastics at 20, again remain unchanged. So overall, a diversified business broken up by geography, end market, as well as business verticals. I now move to slide number 5, which gives a quick overview of the Indian automotive industry performance for 9 months as well as the third quarter. If you see on the top left-hand box, the 9-month number, you'll see that the auto industry overall has gone down by about 13.2%. However, the largest fall has been in commercial vehicles, which is at 26.8%, and the two-wheelers have fallen by about 12.8%. On a mix from our side, the commercial vehicles and two-wheelers constitute a significant part of our sales mix. So if you do a weighted average, wherein my exposure in India to two-wheelers is about 50% and commercial vehicles is close to 40%. So if you use a weighted average method for the industry fall, this would 13% would roughly translate to 18%, given our product mix. Of course, Q3 is more a continued reflection of the same full year trend. You will see that again, commercial vehicles is about 27% dip, and the auto industry in general has gone down by 12.7%. The reasons for the fall are all evident to all of us. Just to reiterate, it is subdued economic environment, pretty low consumer sentiment, tightening of financial availability, and we expect this specific factor to change over the next 3 to 4 months, given yesterday's RBI CRR change, which is making it cheaper and easier for banks to give loans against vehicles and homes. We see that as a big positive. Destocking of BS4 vehicles has also contributed to this. So the last bullet, we see it more as temporary and hope to see changes during the first and second quarter of next financial year. Coming to our results on page 6, on a consolidated basis, you'll see that we have a quarter 3 operating revenue of 671 crores, and this is a 12.37% fall as compared to the same quarter in the previous year. On a weighted average overall, the industry for us fell by about 18%, and we are down to about 12.7%. Here, it is a mix of India and Europe. Specifically, India went down by about 10%, and Europe went down by 17%. So on an average, we ended up showing 12.7%. In terms of EBITDA, there has been a significant improvement in our EBITDA margins as well as the quantum. So from a 54 crore EBITDA during the same quarter previous year, we have moved to 76 crores EBITDA. This effectively is a good change from 7.1 to 11.3. The roughly 420 basis points increase in EBITDA in this quarter has largely come from about, if I break up this change as to where all have the improvements happened, you'll see that our security systems and die casting business has roughly contributed about 200 basis points. KTSN had a very tough quarter during FY19 Q3, and some of that has been improved during FY20 Q3. So that has contributed to an increase of 120 basis points. However, our wiring harness business, which has remained challenged particularly in the last quarter because of this huge change from BS4 to 6, has seen a 50 basis point dip. If you look at these changes overall, I would say about 80 basis points is one-off in this 11.3% increase. However, company as a whole, the profitability has significantly improved. 3 main points I would like to say. One is the RMC initiatives. You'll see that on a standalone and consolidated basis, our RMC as percentage of sales has gone down. The control that we have established due to a tough year and austerity measures on fixed cost has significantly given results, as well as a change in our mix of our product wherein we did less amount of tooling sales and more amount of serial sales, which has contributed to some positive numbers. So this is the EBITDA numbers. Going to profit after tax, we have posted a 41 crore profit after tax, which is a 6.1% to sales. And as opposed to the same quarter in the previous year, we did 5.7. On a 9-month basis, we are posting a 100 crore profit after tax, which is 4.7%, as against 127 crores, which is 5.4%. Of course, this 127 includes one-off extraordinary income that we had in Q3 of last year, including the part sale of our stake in Minda Furukawa Electric. Happy to share that the company has also declared an interim dividend yesterday of 17.5%, which is effectively 35 paise per share of face value, 2 rupees. Going to the next slide, page number 7, is more a graphic representation of the same. You'll see that domestic industry volume fell by 13, commercial vehicle fell by about 27, and two-wheeler by 13%. We also had lower tooling sales in Minda KTSN. The EBITDA margin increase of 420 basis points is what is explained here. Again, going in reverse order, savings in raw material costs, a favorable product mix, reduction in our fixed cost in India, which is a big positive for us, and some lowering of losses in Minda KTSN. The other reason why the PAT has been impacted positively and negatively, the favorable impact has been because of high EBITDA margins as well as lower tax rate. For example, our effective tax rate compared to 30.8% as to what it was has gone down to 25.8% on a standalone basis. The adverse impact on our profitability has been because of lower profits that has come from our joint ventures. Last year, same time, we made about 21 crores from our joint venture in the 9 months, and this year it's about 10.4 crores. Of course, we don't have any exceptional gain this quarter to show as against what we showed in the last quarter, same year, so last year, same quarter. I'd like to move to slide number 8, where we actually present our segment, our business-wise breakup. We have split our business into 3. One is mechatronics and aftermarket. The reason for clubbing aftermarket because a majority of the products that we sell in the aftermarket belongs to mechatronics. The second vertical, which is information and connected systems, and the third, which is plastics and interiors, largely based out of Europe. The mechatronics and aftermarket has seen a revenue dip of 4.7%. This revenue dip has been arrested largely because the export business and the aftermarket business have shown a positive trend in the 9 months, because of which the fall is that much cushioned. The EBITDA improvement, particularly in this segment, is because of raw material cost improvement as well as fixed cost reduction, and therefore EBITDA has moved from 12.3% to 14.4%. Coming to the second business, which is information and connected systems, 27% fall in the commercial vehicle industry has led to a significant similar fall in the commercial vehicle share of ours in this business. And on an aggregate overall basis, this business has fallen in sales by 13.1% over a 9-month period. The EBITDA drop has not been that significant. From a 9.9%, the division has managed to maintain an EBITDA of 9.2%. It will be pertinent to mention here that our dependence on commercial vehicles for this particular business is roughly was about 46% last year. So therefore, the fall in commercial vehicle sales has impacted this business. Coming to the last box, which is our plastics and interior business, our sales has gone down by 11.3% from 483 crores to 428 crores. The revenue has fallen largely because of lower tooling sales, and lowering of tooling sales has been a consistent phenomenon in KTSN. The EBITDA margin is low because of the challenges I've mentioned in the past in our European operations. We have a high fixed cost, we have a challenging inventory passover regime, as well as we have extremely competitive pricing with respect to our customers. Effectively, I would say the EBITDA margin of this business is almost zero. We do have a one-time gain because of certain compensation by the customer, and therefore it is showing as 0.9. Going to our next slide with respect to our order book. This is a business update on our Q3 FY20. Mechatronics business, which is our first business vertical, there has been an increase in lifetime order in Q3 to the extent of 870 crores. It's important to mention here that out of the 870 crores, a majority of that, which is 500 crores, has come from die casting export orders. And it's also important to mention that out this 500 crores has come from our existing customers, and it is a transfer business. So to that extent, our time to go to start of production will be much lower than what would it be had we actually gone through a typical product life cycle. Very positive news with respect to bullet number 2, sub-bullet number 2 in this one. We have won a prestigious order for DC-DC converter for a leading two-wheeler OEM. This is basically the electric vehicle of Bajaj, and this is being over and above the business that we won earlier in the locks and key business for the same product, which is Bajaj Chetak. I would like to add here that with this move and the move of winning the key set lock business at Bajaj Chetak, this is a one classic case where, thanks to our R&D efforts over the last couple of years, as well as a very integrated approach with the manufacturer, we have demonstrated that we can move from a part supplier to a system supplier. So, for example, for this particular product, we used to only give a lock and a key. Now we give electronic steering column lock, we give key fob, electronic control unit, seat actuators, glove box actuator opening mechanism, and now the DC-DC converter. So effectively, it is going more as a system supplier. Hope to do more of this going forward. Of course, we have also been awarded new business globally in a passenger vehicle OEM, which is effectively the seat latch. On the second part, which is information and connected systems, we have won a lifetime order in Q3 of 190 crores. The new business was the speedometer for a leading two-wheeler OEM, aggregating to about 40 crores. We also won electronic EFI wiring harness from two of the leading OEMs. This is part of the move from BS4 to BS6, and therefore this is what we always expected. The plastic interior business has again won some orders of worth 60 crores this year to supply central console to a leading domestic passenger vehicle OEM. This is a demonstration of our transition of technology that we have in Europe to convert that into profitable orders with Indian OEMs using our plastic expertise that is there in Germany. The effort has been on for a couple of years. For the last 2 to 3 quarters, we have been seeing much more robust traction and winning orders for this business. I've covered the export in my discussion in the first bullet itself. And that brings to an end the business update on page 10 in terms of our way forward in India as well as global in Europe. Our opportunities and challenges remain the same, and we are totally focused on the response and outlook that we give for each of these businesses, including mechatronics, information connected systems, and plastic interior. We look forward to exports and aftermarket to enhance and give us an additional push so that we continue to deliver top-line performance which is superior to industry. Of course, that is with respect to the top line. With respect to the EBITDA and bottom line, our endeavor will be to continue to give superior performance by either cost control, raw material savings advantages, etc., and therefore try and maintain our consistent double-digit EBITDA margins. That's all I have to present with respect to the business. We have, again, as usual, won a fair amount of awards in CSR as well as the recognition from OEMs, which I shall leave it for the audience to read at leisure. So thank you very much.